Welcome to Elevate Market Chat. My name is Kyle Lotman, and I'm a wealth management advisor at Elevate Capital Advisors. Elevate is a registered investment advisor managing over $175 million for private individuals and families, corporations, family offices, charities, and others. Once a month, I sit down with Shane Fleury, the Chief Investment Officer at Elevate, to discuss the market trends and all things investing. This episode was recorded July 17th, 2025. In this episode, we get into the S&P 500 hitting new all-time highs and investor patience. We then move on to market valuation, investment strategies, and the Federal Reserve's impact on inflation. Thanks for tuning in. Shane, how's it going?
Kyle, I'm full. Thanks for waiting for me to eat a little bit of dinner. We're recording this a little later than normal because I unexpectedly had to do a little baby watching this afternoon. So market's closed. It's a little after 6 o'clock on July 17th, 2025. And looking forward to chatting with you a little bit, man.
Yeah, as am I. It's kind of fortunate that we're having this conversation and we just put a new all-time high in for the S&P. So, markets are looking good. If we only look at that number, that's a good thing. So we'll get into some of the underlying movement that's taken place, just some of the themes, but it's a bullish year so far. I don't know many bear markets that have new all-time highs in them, so take that for what it is. But I just thought, start with a little market recap here. Market year to date, so the S&P is up 6.5%. That was before today's close, so now it's just a little north of that. NASDAQ's up 8.4%, the Dow 4.4%, and then gold, which has been the leader in all of this, is up 25.6%. So, looking pretty good.
So wait, we're in a raging bull market in stocks, but gold is up multiples of what the stocks are up.
So isn't that interesting?
Yeah, that happened last year too. I think I wrote about that more than once in my commentaries, and I think the year before. And if you look at gold versus the S&P 500 and gold versus the NASDAQ going all the way back to, I think 2000 was the last time, or the chart I prepared in one of my commentaries, gold is up like 1,000% compared to only 600 or 700% or something for the S&P and NASDAQ, which, yeah, fascinating how great gold is, because most people just make fun of gold bugs for not owning stocks and owning too much gold. But I mean, if you look at the last 25 years, I don't know. Looks like it's pretty smart to have a little bit of gold in the portfolio and probably in the safe at home. And yeah, it's interesting.
Mm-hmm. And what's interesting with gold too is that if you make fun of the gold bug, or you go look at a chart and think, oh, well, I should have done this or that. It put in a lot of years of doing nothing, just choppy sideways action. And that's what's challenging with investing, is that when you see a stock or a different asset class make a new all-time high, it's tempting to think, oh, I need to go jump into that one. But then what happens is you have this, sleeper like gold that was doing nothing for so long, then takes off. So you can end up just kind of chasing your tail. So
yeah, I can't tell you how many stocks we've had like that in our portfolios where I'm looking at them and like, the GIF where you're like poking it with a stick saying, do something, I mean, I don't care. Just go down. I don't like, do something, anything. And, a stock will just go sideways and sideways and sideways for seemingly years. I think EQT was like that for us, and Axis Capital, the insurance stock. And then, man, when they go sideways for long enough, it's like they're getting wound up, and the move that they finally make when they do finally make it is just like relentless. Because both of those stocks, once they started going up, are just, and that's just a couple that I can remember talking about recently. I know there are more, but it's almost kind of like you gotta pay your dues sometimes. Some of the best ideas we've ever had are the ones that didn't do anything for a couple years, and then we just hung in there. We look at the financials, we say, gosh, this business is gushing free cash flow. They're returning it to shareholders via dividends or share repurchases, and margins are improving, revenue is accelerating, and they don't go anywhere. And then one day the market figures it out and boom.
Hmm.
So sometimes you just got to pay your dues and know what you own, not get too carried away if they don't go up the moment you buy them.
Yeah. And if we were to look at what has run and what might be expected, I think just looking at the S&P 500 for starters is a good place. I did not expect it to be up like it is so far this year. I thought it was normal to bounce like it did this spring. So we had that sell off and it did bounce. But, there's this technical metric you can use. It's called the Bollinger Band indicator, I guess. And I don't want to get technical, but I'll just explain something simple. When price just runs away and doesn't take a break, it's kind of like when you run a marathon. You don't want to bet on the marathon runner that is halfway through the race and they're just at a dead sprint. They'll probably hit a wall. They need to take a break before they get going again. In the S&P right now, it's touching that outer Bollinger Band. So it's moved away from this average. It's just been on this momentous run and now it just seems normal it would take a break. So that's one thing I'm seeing. Yes, the trend's up. Yes, I'm bullish if I'm just looking at the chart, but I think we're just due for some of that, sleeping period. Uh, I know if we're looking at the valuations too, maybe you can talk to that, but just like the PE multiple, what's the latest on that, and how do we kind of think about what that means from a valuation standpoint?
Well, yeah, I think we're way overdue for at least a breather. But gosh, that breather was overdue weeks ago, and no breather is happening. So I wrote about it plenty in the commentary that most recently came out on July 11th, I think it was, Friday. And it's what Paul Tudor Jones and the wrestling people call kayfabe. It's all fake, and the market just disregards everything that ought to cause it to take a breather and says, "Nope, give me more. We're going more. We're going higher." They just total suspension of disbelief, and just buying. FOMO has kicked in, and now all those people are trying to catch up. I mean, we even have some people in our book of business that they decided they wanted to get out uh, when the tariffs were on the table and things were looking pretty grim. And now they're those people who made those decisions essentially against our best advice. Are now looking for ways to get back in. And they're saying, hey, if I sold back in April and I'm still not back in, is that too late? Can I get back in now? And no, I generally my position is that you should just invest in alignment with your willingness and ability to take risk and with respect for your liquidity needs and time horizon. I mean, those are the only factors that matter. And most people should not try to time the market by saying, hey, I feel one way or another right now, and so my portfolio should be like this. We've just seen it too many times where people who are working full time and they're a doctor or an attorney or um, some other type of executive or an entrepreneur, and they're doing that all day, and so they're not focused and they're not ready to get back in when despite all odds, like things start going higher, and it sometimes takes them a few months to like take a breath from their own world, their own busy life, raising kids or whatever it is. Um, and when they finally do look, they're like, holy smokes, um, the market went a lot higher, you know, than I thought it could in such a short period of time with all the bad headlines that were out there. And, then it's like, hey, is it too late? And I just I don't think it is too late. I wouldn't want to. I don't know. It's kind of a hard thing so I'm not giving blanket advice by any stretch of the imagination, right? This is for education purposes only and all that good stuff. So I mean, you have two things going on. It's like, well, where else are you going to put your money? And yeah, I mean, like you said, the PE ratios they're obnoxious. Like if you're buying stocks right here, like let's say you're just buying the S&P 500, you're a passive investor, one of these relentless bid types. I mean, history says you should expect basically a flat return from here for the next 5 to 10 years. If you just the data exists, and so when people buy stocks with the PEs that we're at right now, whether it's rear PE for backward-looking PE for the trailing 12 months, or forward PE for earnings over the next 12 months, or the CAPE ratio, which is cyclically adjusted price to earnings rate. I don't care which measure you use. If you go study, hey, if I bought every time um, that the ratio was this high, what was my return 5 years later, and what was my return 10 years later? And the answer is basically zero on average. So on average means it's the middle, right? So there's some that were better than that and others that were worse than that. But by and large, on average, you should expect a return right around 0% for the next 5 to 10 years if you're buying stocks at these levels. Um, that doesn't mean there aren't stocks out there that are trading below their intrinsic value estimates, or their fair value. And we don't know exactly what any company is worth. We have to estimate it like everyone else based on what we think future cash flows will be and all that kind of thing. And I've been over it before, so I won't bore people to death here. But we don't waste our time trying to predict cash flows. We look at what's the market pricing a stock at today, and what does that imply about future cash flows, and then we just say we assess the reasonableness of that estimate, right? So if a stock is currently trading at 100 and that implies, say, free cash flow growth of 25% a year for the next 10 years, but somehow the company's like doing less and less revenue, we would say that's not reasonable. It's not reasonable to expect a company with declining revenue to produce a 25% cash flow growth rate for 10 years. So if that's what the current market price is implying, then we would say that's too rich for our blood. We're not going to buy that one. But you can still find gems out there where the market may be mispricing um, the free cash flow generation power of a given business, because everybody's focused on Nvidia and everybody's focused on Microsoft and the other Mag 7. So there are other companies out there that, while not cheap by any type of market metric like price to sales or price to earnings, are cheap based on our assessment of their earnings, their free cash flow production over the, say, a 5 to 10 year period. So we're still finding some opportunities to put capital to work, and so that's kind of the beauty of not just dumping all your money into the S&P 500, which again, I'll plug my commentary from last week again and say, like, I went over why index investing is full of logical fallacies that don't make a whole lot of sense. Um, so I like our way better. That's why we do it this way.
Yeah. And one thing too, it may be overvalued right now, but there's one distinction to make, and it's that doesn't mean that it has to sell off 50%.
Oh yeah,
We're not looking at, oh my gosh, this is doomsday scenario, avoid stocks altogether. It's just, hey, if I'm going to give you some level of an expectation, it's that this needs to work out over time and you need earnings to catch up so that it looks a little more normal. And
yeah,
there's some positive years that are probably going to be in there, but we don't know when it's going to happen. We were talking about that idea of sometimes you feel like you're just sitting there waiting for it to move and kind of prodding it along with a stick. But it's good to still be invested. Make sure the investment plan you have set is a good one for you. And somewhere along the lines, there's going to be that really good year. But you and I, we don't know when that is. But you just want to be aware of the fact that, yes, it's overvalued right now and consider that in, your overall plan. But yeah, don't be going, hey, time to go all cash because the world's ending. Certainly not the
yeah.
scenario.
Well, and the world's best investors don't ever actually behave that way, right? Like the guys who have produced 20 and 30% returns year over year for their entire career, right? Like the drunken Millers of the world. You don't ever hear them say, "Oh, I went 100% to cash." They've like never. That's never happened. That's not a thing. Nobody does that. No serious professional investor ever just wholesale makes changes like that. They hedge, they get a little bit more bearish, they get a little bit more cautious, but it's not like, "Hey, I'm just going to sell everything and go to cash." That doesn't actually happen. And there's all types of, sayings out there that I think are um, relevant and prove this point out. But one is the market can stay irrational longer than you can stay solvent, right? So and I mean that's like just a kind of a funny, idiom that that we have in our industry, but something I've told people for, a while now and has proven to be true is like say just take a stock like Nvidia. Nvidia is like, I don't know, 4 trillion some dollars now of market cap. It's within a sneezing distance of being worth the same market cap as the entire Euro Stocks 50. The biggest 50 stocks in Europe uh, are like just barely more valuable altogether than just one American company. Um, that's crazy. Like just doesn't even pass the sniff test. It's like that's not very reasonable. And so a company like Nvidia, if it's if it's unreasonably priced, if it makes absolutely no fundamental sense whatever to be worth, say, $3 trillion, well, it makes absolutely no fundamental sense when it's worth 4 trillion or 5 trillion or 6 trillion. So it's like just because something doesn't make any sense doesn't mean it can't keep going up. Things that are expensive just get more and more and more expensive when when the economic backdrop supports it, like when there's just massive amounts of debt being taken on and massive amounts of money being pumped into circulation. Um, I mean, things can make no sense for a long, long time, and eventually, yeah, they'll, reality will come back, and people will pay attention. But gosh, I mean, even in April, when people started paying attention to reality for a millisecond, um, there was just a new narrative put out into the market, and they said, "Oh, let's latch onto that, and we'll buy stocks again." I mean, going back even to 2022, when the market was down, what, 30% or something from peak to trough, close to 30% anyway, and in a bear market, finished the year down big. Um, I didn't, I that the market never got to a point where it was cheap, even then. Like,
Hmm.
I put some charts in the commentary that showed, I think the valuations, the index valuation going back, I don't know, 10 years maybe. And if you look at what they got down to in 2022, it was barely to like the average price for a moment. It was never to a point where it was like below average valuation. So we haven't seen a below average valuation in stocks since the financial crisis, I'm pretty sure. Maybe for a moment during COVID. Um, but I don't even think then. I think even then it was like just to an average valuation. So
Yeah. And if you're looking at sectors, I think that's always important is you go look at maybe different pockets of the market where valuations might look a little more normal. And I have not pulled up these numbers, so I can't reference those. But if I'm just looking at, well, what's trending down and what looks cheap, you've got consumer staples, which still is sitting there with only 34% above the 200-day moving average. Doesn't mean they're cheap or good buys, but they're pretty beaten down. I don't know why. I don't know the backdrop there. Healthcare, same thing.
because there's no Nvidia in there, man.
That, and it's just what's the flavor of the month kind of thing. So, you've got that. Healthcare is another one, which United Health Group is probably a large chunk of that, and they got beat down pretty hard. So you could go look for those pockets now, but now that doesn't even promise anything because yeah, they might have low valuations simply because their revenue growth in the future just doesn't look promising. So it's an interesting dynamic. It's yes, you can go do the Nvidia that for them to hit the numbers that lie ahead, essentially everybody has to spend half their income buying Nvidia products to sustain that. And I think people could probably listen to us talk about that, think through those numbers, and realize, yeah, it's probably unlikely for that to happen.
Yeah.
So it's an interesting dynamic. But one thing too is the interest rates. So people keep talking about that. The Fed funds rate right now is just a little over 4%. We're talking about rate cuts. Does that add juice to that, or what happens when we actually get a rate cut? How are you thinking about that now, and what do you think that does in terms of how it will, impact the market?
Well, before I answer that, I do want to correct myself. I just pulled up that chart and looked. It looks like in 2022 and during COVID, the forward price to earnings ratio on the S&P 500 did just get below the average valuation for the past 10 years. During COVID, it actually got to one standard deviation below the average, so that was probably a good buying opportunity. Um, but on price to sales basis, it just tapped the average valuation in 2022. COVID was a better buying opportunity on that one. So anyway, just to correct what I said earlier, I guess you did have a couple of opportunities to buy at a less than average valuation. Um, depending on which metric you're looking at. But yeah, as far as the interest rate thing goes, I mean, the market's mostly focused right now on whether or not Powell's going to get fired and replaced with a dove. A dove meaning people more likely to cut interest rates and pursue a loose monetary policy. I think either way, the writing's on the wall for Powell. His term is up in May of 2026, I believe. Um, so at by then there will be a new Fed chair. The market knows that. I think everybody knows that. And so I think by then you should expect the Fed to be more dovish, meaning more inclined to cut rates, um, and more inclined to do things like QE, less inclined to reduce the size of its balance sheet, all else equal. So all else, won't be equal. There might be a lot of things that happen between now and then with markets and the economy and tariffs. I mean, ultimately, tariffs are going to lead us into one thing or another. Either United States consumers are going to pay more for stuff and eat some of those um, tariff price increases, or companies are going to eat them and their profit margins are going to take a hit, which would, all else equal, again, cause the stock market to go down. And who owns the US stock market? Well, Americans, albeit not most Americans. Most Americans can't afford to invest in the stock market because they can barely afford to pay their bills and their credit card interest and their student loan payments and on and on and on and on and on, which is sad but true. But most people don't own stocks. Um, so ultimately, I mean, lower rates are going to mean higher inflation. Um, More money in circulation is going to mean higher inflation. Um, and so I would expect higher prices. However, so when I say that, most people hear, "Oh no, inflation! I better sell my stocks." That's the exact wrong take. It's the exact wrong take. If you backtest higher inflation, it always corresponds with higher stock prices, right? Inflation means higher prices. Um, that means higher prices of the things you buy at the grocery store or the gas station. And it also means higher prices of things like stocks and gold. Um, Not all stocks are created equal, right? Some stocks like high inflation more than other stocks. So I'm not trying to say every single stock in the world is going to be a higher price due to inflation. But on average, if you see inflation out there, what you want to do is you want to own things that are going to inflate at ideally a faster pace than your costs. So that's a big thing that I kind of want to make sure I even repeat it, is that when you hear high inflation, that does not mean sell stocks. It should probably mean buy stocks ahead of that anticipated inflation.
Hmm.
Also buy gold and real estate and just any asset that is going to increase in price faster than your costs. Very important concept.
Yeah, I think something important on that too is the pass-through rate. So what I mean by that is, if the consumer, so you and I, are short on money and we have limited goods we can buy with that money because they have gotten expensive, if I want the latest and greatest iPhone, they might be able to hike the price because I'm still going to buy that because that's a necessity in my world. I need that new iPhone. So they will perform better with inflation. Now, a
Yeah.
company that's selling something that people don't want as badly, they will not be able to pass that price increase on to the consumer because the consumer will be like, well, shoot, I'll walk away from this because I never really liked it that much anyways. you know,
Mhm.
that can be different stocks in different industries, but that's a key thing there with inflation is that if they are able to pass through that higher price to the consumer, then they look pretty good. Um, and Shane, the other thing I want to hit on is just the interest rates. So I get asked a lot, well, or I shouldn't say asked, it's more a statement that I get is the Fed's going to lower rates, so I will borrow then because mortgage rates are going to go down, car loans are going to go down, all that. Can you kind of just give a little summary on how it works? If the Fed, let's just say they dropped it to zero tomorrow. So the Fed funds rate was zero tomorrow. What is that going to do to the 5, 10, 30-year bond, which kind of spills through to the other financing instruments?
Yeah. Well, I can't tell you for sure, but what I can tell you is that the Fed does not set the interest rate for 5-year and 10-year and 20 and 30-year notes or paper or borrowing. They attempt to influence um, these longer term rates by setting the overnight lending rate that banks charge to each other to meet their reserve obligations at the end of the day. And so, without getting too far out into the weeds of why banks have to borrow money for from each other for overnight purposes to meet reserve requirements. I can just tell you that, if I'm Bank of America and I'm short on what the Federal Reserve requires me to have on my balance sheet, um, to satisfy my general consumer's checking account balances, right? There's a certain amount I have to have. If I have a certain amount in checking accounts, there's a certain amount I have to at least have in reserves in order to meet what are called demand deposits, where people can, swipe their credit card or go and make an ATM withdrawal. Like you have to have a certain amount of capital on your balance sheet at the end of every single day. And if you don't, you can end up being shut down by the Fed as a bank. So if I'm short at the end of the day today, what I'm going to do is I'm going to call up my buddy Jamie Dimon and say, "Hey Jamie, can I borrow can I borrow $100 billion? I'll give it back to you tomorrow morning." Right? So it's 4 o'clock in the afternoon. Bank's going to close in an hour, and I'm saying, Jamie, who's the CEO of J.P. Morgan Chase, if you guys didn't know, I need 100 billion, but I only need it till the bank opens tomorrow. What are you going to charge me? I'm good for it. And Jamie's like, "Oh, you're Bank of America. Yeah, like you just need it overnight just for this meet this stupid requirement. I'll charge you like peanuts, right? I'll charge you like $10 to borrow 100 billion." So if that's all your cost is at Bank of America or as a bank to meet your reserve requirement overnight, you don't really need to pass much of that $10 cost on to your customers in the form of, some other higher interest rate that you're going to charge on, the mortgage lending that you do as a bank or the small business lending that you do as a bank or any of that other kind of stuff. Now, if I call Jamie and I say, "Hey Jamie, I need 100 billion, I just need it for overnight. I'll pay you back in the morning, right? I need it for less than 24 hours." And Jamie says, "Instead of $10, the Fed has raised their overnight rate that I'm allowed to charge you. So I'm going to charge you, 20 billion or 200 million, whatever. It's a lot more than $10, right?" And so if I'm Bank of America, I'm like, "Well, gosh, I got to borrow it. Jamie's now jacked the juice up on me. I got to pay him 200 million instead of $10. Well, I'm going to have to raise the rate that I'm charging my customers when they come in to borrow money in order to, to cover that 200 million overnight loan. Well, so ultimately it trickles through, right, to the end consumer, in the form of higher auto lending rates and higher mortgage rates and all that kind of thing. And it works the same way in reverse, right? If the rate went from a higher rate to a lower rate, ultimately the rates would come down on mortgages and auto loans and things like that. Again, all else equal, but all else is never really totally equal. And what I think will happen is not much. I mean, you saw the Fed cut rates last September for the first time. They cut the they ended up cutting by, well, they cut by 50 basis points the first time and then 25 basis points two more times. So they cut by a whole 100 basis points or 1% starting in September of 2024. And if you go back and read my commentaries from that time period, call it October, November, December, you will see that I was writing about how the 10-year rate went up, the 5-year rate went up, the 30-year mortgage went up. All those rates went up despite the fact that the Fed was cutting rates, because what happened is the people who actually the supply and demand function of the debt markets was such that they're saying, hey, the United States is in like $35 trillion in debt at the time. Now it's $37 trillion in debt and going to be growing thanks to the new bill that was passed. Um, the supply and demand curve or function says, well, there's no way they're ever going to pay this money back. I need a higher interest rate in order to be able to lend money for 10 years because I don't think the person borrowing it's going to be able to pay me back. I think they might default. Certainly, the chances of them defaulting has increased, so I need to be paid a higher rate to lend somebody money for 20 or 30 years, despite the fact that the Fed has reduced the overnight rate that Bank of America and JP Morgan Chase charge each other on an overnight loan. So I don't know that you wanted me to go into all that detail, but it's kind of a hard question to answer without giving some background. But I mean, that's essentially how it works in layman's terms.
Yeah, no, that's a good explanation. It's, part of the longer term influence on rates is just if there's doubts in getting paid back, then a 10-year interest rate would be higher than a short term because there's more time for things to happen. More feeds into those doubts. The other part too is just simply if people listening to this, think about your individual situation. And retirees do this all the time. I want to go buy fixed income, but well, shoot, I'm only getting paid 5%. That's not that high. So I'm not going to buy fixed income. And you see, when you buy that fixed income, those dollars flow through to being lent out to somebody for an auto loan, a mortgage. So you're sitting there, you're holding back the supply. There's fewer dollars going to those people, and you're waiting for those higher interest rates. You don't really care what, the Fed chair has in store. You're just like, hey, 5% is not high enough. I want more. So, a few different factors influencing that. But yeah, just to kind of bring it full circle and wrap us up, Shane, you mentioned, the debt problem, and now we have the big, beautiful bill that was signed in on July 4th. Is there anything right away you're like, oh my, this is a big market impact? Or is it kind of, how do you look at that? Is that something big to be considering?
Well, yes, and for way more reasons than we're going to have time to talk about in the remainder of this call. So I don't know how much of that I want to get into, but I'll tell you what the biggest concern to me is about all this going on. I mean, aside from the fact that, well, number one, I would encourage you all to go read my most recent commentary. It's not a very long one, but I think it gets across some very important points that are driving the markets in the way that they're driving them right now. And that'll go on for as long as it can go on. But things that can't go on forever don't, right? And we can't just keep borrowing money and running our country at a multi-trillion dollar annual deficit. It's just it can't go on forever. I don't know how long it can go on, obviously for way longer than most people think possible. So I'm not saying it's all going to stop tomorrow. But things that can't go on forever don't. And I think if you look at the value of the US dollar right now, you will see that The rest of the world doesn't really believe that we're going to be able to pay back our debts. The dollar is having its worst year in a very long time. What concerns me the most is that during the tariff dust up in April, when the market was down almost 20% from its highs and almost down 20% for the year, normally what you would see is people buying lots of dollars. The dollar goes up, right? When people are selling stocks, all around the globe, really, people usually flee to the dollar and flee to the short-term U.S. Treasury note, and because that's a safe place, that's the port in the storm. It has been ever since I've been in this business. I've never seen a time where the market pulled back by that much, that aggressively, that quickly, and the dollar and the short-term Treasury didn't rise in value. But we did not see that happen. In fact, the well, the VIX and the volatility index and the dollar are like normally inversely related. So when one's rising, the other's falling. But that was the first time that I can ever remember where they both dropped together, and the dollar is still dropping. It hasn't bounced at all. So stocks have bounced, and um, lots of crypto has bounced. Bitcoin's at an all-time high. I mean, all these FOMO, go momentum type things are all bouncing and ripping higher, but the one point of safety never did rise, and it still isn't rising. It's just dropping. And I think that what has happened is, the rhetoric out of Washington D.C. and the trade wars and all these kinds of things have really shaken the rest of the world's faith in our currency. And time will tell. Could just be a phase and everything bounces and recovers from here. I don't really know. But if it doesn't, um, I think that means there's a lot more trouble out there to come. And when it does come and it begins to be priced in and realized by the market, it could make the stock market drop that we saw in April look like child's play. And I'm here to tell you, I'm old enough to remember April. Um, Market was down like 5% a day, like 3 or 4 days in a row. It was quick that it went down. And trust me when I tell you that can and probably will happen again. And it certainly could go on for a lot longer than it did in April, and we could be down 50%, you know, before you know it. I mean, that could happen later this year when tariffs may, whether they go into effect in April or not, who knows that it keeps getting pushed out. Um, but anyway, I mean, if we're in a new paradigm where the U.S. dollar is no longer the port in the storm and people don't want U.S. treasuries because nobody believes we can ever repay the debts that we have, um, look out because there's a lot further down this thing can go, especially from these sky high valuations. So I'm not predicting that. I'm not saying that's going to happen. I'm not trying to scare anybody. I mean, we're at max long stocks in all of our portfolios, except for like some new people who have joined us and have some cash that we're not, aggressively putting to work for reasons we've already discussed on this call. Um, but we're max long. We're not selling. So I'm not trying to freak anybody out, but I'm also not totally oblivious to the reality that we're never, ever, ever going to pay back $37 trillion in debt in today's dollars. The only way we'll pay that back is by printing $37 trillion and look out inflation when we do that.
Yeah. And that's where I think my takeaway on it is I think that the approach seems to be we're going to grow our way out of this. Tax rates kind of remain the same, which it's good for you and I get to keep more of our dollars. So that's always nice. Um, I would have liked to see spending get cut down more, but
Oh
it
yeah,
is the government and they're really good at spending money
they will
and not
never cut that.
necessarily. Yeah, so I don't know how it resolves, but I do know how to plan, and the planning side of it is simply tax rates. They're favorable right now, so that was a good thing. And I don't see the doomsday scenario staring at us in the face. It seems to be that the stock market viewed it favorably, and that's where we stand. So we'll
Yep.
see how it unfolds. But you and I, we're not policy analysts, and even those that are seem to still be getting it wrong too. So
Yeah.
it kind of fool's errand to try and predict this.
That's why I like the opening quote to the commentary. It was oh gosh, I'll butcher it if I don't look at it, but the function of economic forecasting is to make astrology look respectable. So
I
who knows, right? The only responsible thing I can guarantee you this. The only responsible thing to do when investing in a bubble, which I think we're in kind of an everything bubble as based on every type of valuation metric you can look at, is to get long and use trailing stops to get out. So if you're sitting on the sidelines and you're wondering what to do, number one, call Kyle because he can help you get invested like safely. But if you want to do it yourself, just go buy the most crazy aggressive thing you can think of, a levered QQQ ETF or something, and just buy the snot out of it and put a trailing stop on. Again, not advice. I'm not saying that's a good idea, but if you're in a bubble and you think stock things are just going to go up and keep going up and keep getting, even more fundamentally obnoxiously valued, I mean, who knows how long it will go on before it stops. So the only responsible thing to do is to be long and have your eye on the exit.
exactly. So good information. Well, Shane, I think it's time to wrap this up. Thanks again for taking the time to get on here and kind of share your thoughts. And, we'll be on here in a month again and getting this out. But, always fun to catch up on the markets and just kind of see what you're thinking.
Always a pleasure, my friend. Have a great rest of your evening.
All right. You as well.
See ya.
Bye. Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.